Now, that was a very exciting first part of our 3-part series, but this second part that's coming up, which is how to structure your insurances like the wealthy people do, this is actually really important because there's going to be some hacks in there that we're going to talk to Adam about regarding minimising tax in a way that you can still pay for your insurances accordingly inside super. Also understanding what level of insurance cover is needed, and more importantly, not allowing apathy to creep into our everyday decisions. There's going to be some money-making benefits in here, so make sure that you tune in for our second episode where we speak to Adam and we go in depth about insurances and what the wealthy people are doing to maximise their benefits. If you're not sure if this episode's for you, I'm going to ask you 2 questions right now. When's the last time you checked your insurances with inside your super fund? And if you have, how much would you actually get paid if something happened? If you don't know the answer to one or either of these, this is an episode you can't afford to miss. I'm Jeremy Iannuzzelli, and this is what school should have taught you. Now let's get into episode number 2.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Welcome back to episode 2 of this 3-part series with Adam Chalk, a financial planner with over 20 years of experience, the principal planner and principal of Fruition Wealth. Adam, thank you very much for joining me for this second part of our 3-part series. We're going to be discussing about how the wealthy structure their insurances. And mate, I've got it's not a bone, it's not a gripe, but it's this old saying that only the wealthy people can afford financial planners. You've copped a bit, well, not you, but financial planners in general have copped a pretty bad rap since the Royal Commission with a lot of things that financial planners at banks were doing or financial planners in general. So I really want to make sure we take this misconception out that there's a lot of great people in the industry, and financial planners hold such a crucial part in our professional pyramid, professional square, professional circle of people that we need to have around. So I want to break that mold that no, financial planners just aren't for the wealthy. Financial planners for everybody, and that crucial part of insurances is another service that financial planners do. So, Adam, I want to lead us into how are people structuring their insurances and what are the insurances available to us and how they can be beneficial for us in the long run. So apologies for throwing all that at you straight away, mate. Welcome. Thank you very much for joining us for part 2. Mate, if you can lead us off with a bit of insurances. What are they in terms of finance insurances that a lot of financial planners obtain for their clients?
Awesome. Thank you, Jeremy, mate. Thank you for having me again. Well, as always, it's a pleasure to work with you and your team. All right, starting with insurance, I guess as an overview, there are 4 key insurances that we sort of deal with. There's life insurance, which is self-explanatory. You're dead, you're dead. There's total and permanent disablement insurance, or TPD. That generally is paid when 2 doctors designate that you will never work again, so you are permanently disabled. And they're the common insurances that are normally linked together and put into your super fund. So if you look at your super statement, you'll normally see a life and TPD policy in there. Often, a super fund may send a letter if contributions aren't received to have those insurances cancelled, because obviously there is a premium cost to those insurances. So it's just important to be aware that you might have an old super fund, think that there's life and TPD in there, but it has been cancelled on you if money hasn't flown into that fund and you haven't elected to retain that insurance.
And is there a specific balance requirement? So let's say for argument's sake, you may have 100 grand in super, but you haven't had any contributions go into it. Would the super fund still cancel those insurance, or is there like a balance requirement?
Now, generally, if they haven't received the contribution in a 12-month period, they will send you a letter saying, we haven't received money, do you wish to retain? And give you a period to either elect to retain or cancel that insurance. The philosophy there is they don't want balances eroded by premiums for insurance people don't want. So I guess, be across the insurance within your fund, irrespective of the balance, if money isn't flowing into that fund.
And I'm assuming that's one of the probably outcomes from the Royal Commission. Is that correct?
Oh, absolutely, because balances were eroded by premiums, but as a catch-22, then insurance gets cancelled when you don't want it cancelled. So certainly something to ensure you review regularly, and don't take it as a given that insurance is going to stay with you forever, because like we flagged, they, unless you elect, it can be cancelled on you.
And coming back to what I said before in our first part of the series, again, I'd probably say 8, if not 9 out of every 10 people that I speak to don't know what insurances they've got in their super, don't know what the value or the cost is of those insurances. So it is, yes, it's not coming out of your pocket today. It's a cash flow deficit for the future you, but it is so imperative to really review your insurance and the balances and what you're paying as if it was coming out of your own bank account. It is so important to do that for the 2 reasons. Number 1, you don't want it to drop off. Number 2, you don't want to get it too pricey either. Sorry, Adam, I'll let you continue. So we've got life and TPD, which kind of blend together in most people's super fund statements. What are some other insurances available to us?
Then you've got trauma or critical illness insurance. And that's really designed to fund a short-term illness. So, for example, a stroke or a heart attack or a diagnosis of cancer, for example, you're not dead. You arguably aren't permanently disabled. Just using, say, prostate cancer as an example, a male can have their prostate out, be returned to work, in 12 months or whatever that sort of recovery looks like. So your life and TPD aren't going to pay, but a critical illness policy is designed to pay on that diagnosis to allow you to have a lump sum to, fund short-term medical bills, have additional, care if required, and really take the pressure off financially. You cannot have that insurance in super. The reason being, if you're 40 years old and that policy paid to a super fund, you wouldn't be able to get it out of super because you haven't met a condition of release. Without getting technical, you either need to be retired and over 60, dead, permanently disabled to access money out of super, but a trauma policy wouldn't. So that's normally going to be funded from your cash flow. And then the fourth insurance, which is sort of your backstop and probably arguably the most important insurance, is your income protection. So that is paid on your inability to work due to illness or accident or sickness after a waiting period. So normally we say after about 30 days, this policy will kick in and cover up to 70% of your wages up to a benefit period, which you specify. Generally, we specify to 65, which is a normal retirement sort of time frame. So you've got those 4 sort of insurances that are available, and really as part of a wealth protection plan, all have their role in that sort of protecting your assets.
So just recapping on those 4 insurances. So we've got life and TPD, which kind of blend together. One is for your existence here on this beautiful planet, and the other one obviously based upon you having a disability, not being able to retain or return to work. Now, those ones there, as we know in most circumstances, Adam, and this is the accountant coming out of me, they're non-taxable. So if they are paid to you, there's no tax implications. Is that correct?
Correct.
And then you've got that third insurance you spoke about, which is trauma insurance, not paid from super, but rather paid out of your own back pocket. And again, the accounting coming out of me, trauma insurance, if you receive it, and touch wood, you don't, anyone out there listening doesn't have it, but if you were to arguably get prostate cancer and qualify for a payout in trauma insurance, it wouldn't be a taxable income as well. Is that correct? But you can't claim trauma insurance as a tax deduction. So if you're getting it tax-free as a benefit, then you can't claim it as a tax deduction. But the other one is income protection. Now, that's the last insurance you discussed, where you receive a certain amount of money based upon your inability to return back to work or an event happening, for a period of time. That one there is a tax deduction, but it is also taxable, meaning that when you get paid your income protection insurance benefits, you do, or the insurer will take tax out, or you can elect to get tax taken out, or you will have to pay tax at the end of the year if they don't take any tax out. So they're your 4 insurances. So if you're listening, they're the common stuff. What are people doing? What are some hacks there that you see some very wealthy people do to take advantage of the insurance system to maybe get a tax deduction or to reevaluate what level of insurance they actually need or the type of insurance they need?
Really good question. So following on from that point you made around life and TPD insurance being a tax-free payment, but the premium not being tax deductible. So what would typically happen, someone may realise they don't have enough life or TPD insurance, and Medibank or one of these providers will, who send you the letters in the mail, offer you some insurance, they ring up and they take out their life and TPD insurance. Now, let's say that premium's costing you $2,000 a year. You're paying that premium out of your cash flow of $2,000 a year, and if it's ever claimed on, you'll get the payment tax-free. However, if we have that same policy owned in a super fund and the premium is $2,000 a week, per annum, your super fund's now paying that $2,000 per annum. But you can elect to salary sacrifice $2,000 to your super fund, which is tax deductible, effectively turning that payment into a tax deduction. So if you're on the highest marginal rate, you are now getting half your premium back, or nearly half your premium back, by salary sacrificing the premium into super, whereby salary sacrifice is a tax deduction, where the premium as a standalone in your name is not.
So brilliant. So if you push the premium to get paid from your super, the super pays it, and then you get a tax deduction by salary sacrificing what you're earning from your wage into super, which gives you a pre-tax benefit. And that is a great little hack that you have to be able to get now a tax deduction on essentially an insurance policy that is non-deductible, while still maintaining obviously the tax-free status when the payment or benefit's made. So they're the little things. For many people that's listening, it doesn't sound like a lot, but if you're getting a tax benefit of $400, $500, or even close to $1,000 a year for a very extended period of time, that's brilliant. You could be getting the benefit of a small car over the next 15 or 20 years being paid for simply by making these little switches. What are some other things around, I suppose, value? Because I mentioned at the start, I see people either with none or people that are underinsured or overinsured. What are some techniques, I suppose, you would recommend for people to really understand, what level of balance may be required? What's some of the thought processes people need to have?
Great question. So what I generally do, and it's not a nice discussion around it's a what if discussion. So using myself as an example, my wife is a nurse. So the most she could earn is $80,000 a year. I've got 3 young kids, 5, 7, and 9. So the lifestyle that they're accustomed to, our investments, the school they go to, she would not be able to fund that on her wage solely. And there'd be, an after-school care, leaning on family a lot. So life would be quite tough for Lisa and the kids if something were to happen to me. So we work through a what-if scenario. Well, if something happened to me, I'd at least like the mortgage gone. So then that's a capital amount. Call that $300,000 gone. I would at least like one of our investment properties paid off. So we need another $400,000 for that. Then I'd like to ensure that the school they go to a private school, can continue to be, their school fees can continue to be paid. So then we look at creating a passive income as well, call it $20,000 a year for the next 20 years. And then I want Lisa to have a replacement income or a supplementary income as well, and call that $30,000 a year. So we reverse engineer all those sort of numbers, come up with a capital amount of, call it 1.2, 1.3 or 1.4 million. And then we look at what liquid assets we have against that. So for example, in my super fund, I might have a $300,000 balance. So, that 1.4 less the 300, I need to insure that gap of 1.1 via an insurance policy. So we try to work it out with a scientific approach, so to speak, under that what-if scenario. And conversely, if something happened to my other half with 3 young kids, I wouldn't be able to work the hours I do. I would need to scale back at work or hire a nanny. So I need a provision to allow me to do that. So these are the discussions we're having around, again, not pleasant, but a what-if scenario on either spouse to ensure the family unit can continue to enjoy the lifestyle they're accustomed to.
So it's not throwing a dart at a dartboard and picking a number. It's not about an ego-driven theory where I think my life's worth $5 million, so I'm going to put my insurance value at $5 million, because on the other side you've got probably very hefty insurance premiums that you need to continue to pay to fund that large policy. The context that I'm hearing, or the fundamentals I'm hearing, is there's a scientific approach to really understand what you should have as a level of insurance, especially on your life, which is most likely the largest payout insurance that someone might have inside their suite of various policies, and understanding what you need to leave behind for, your other half or your family to continue on without having the financial pressures that I've seen, some clients leave behind the next, better half or the next generation, a lot of financial pressures for them to take on. So that scientific approach is important. What are some other things people are doing? I know trauma is something I'm starting to hear a lot more clients talk to me about. What are some things you're seeing there? What would you value from a trauma perspective?
And just to circle back to that life and TPD discussion, one thing that I know you hate as an accountant and I hate is wastage. So you want to continuously review your cover, because as your net worth increases, and we're talking about wealthy people, for example, we look after a lot of medical professionals, their net worth, because their income is so high, grows quite quickly. So we might be reducing insurance as they're accumulating assets, or as kids are getting older, that sort of private school fee need reduces. So we don't want you paying for policies that are excessive. So reviewing them at least annually, just to ensure they reflect that gap accurately, is something that I would always advocate, because you don't want to pay for something unnecessarily.
Beautiful. So it could be a sliding scale potentially as you go up and increase your obligations and liabilities. And then on the other side, it's a sliding scale that comes down as you start to decrease your obligations or potentially increase your net wealth. So it's not just a number that's stuck in the sand. It's a number that may float depending on your circumstances. So Adam, bringing it back to, say, the people with a financial planner, those really wealthy people that, have the ridgy-dig, financial planners that are driving their Ferraris and Porsches, what are some of the things that you would say they're doing that you can bring on a level that we can all use?
So what are the key things with insurance? So once we've calculated the amount, the premium that's going to apply, again, it gets a little bit complicated. There's level premiums and there's step premiums. So what level generally and historically used to look like, if you're taking out insurance at 25, 26, up until, early 30s, you would get a level premium. And that was sort of locking that premium in at a young age. But you're paying, considerably more. And that's supposed to hold you, till you cancel that insurance policy. The other way to structure insurance premiums, and it's becoming a lot more popular now, is through step premiums. So they're quite cheap when you take the policy out and you're younger. And as you age, that policy steps or gets higher, the premium does. So again, looking at wealthy people and people building wealth, the reality is their need for insurance will reduce as they accumulate wealth. So that's how you can take advantage of a cheaper premium now by getting a step premium. Whilst that premium will go up, you're reducing the cover to ensure the cost isn't increasing exponentially as well. So structuring the premiums in a way where you're accounting for that accumulation of wealth moving forward is quite important as well.
One of the key things I say to everybody, clients, and I get really passionate about it, is apathy. I feel that too many of us allow apathy to creep into our everyday lives. We accept what the banks give us as a term deposit rate. How many times have people called up and negotiated the term deposit rate with a bank? Or, we accept our insurance premium on our house that year. We accept the insurance premium for our life insurance, or we accept the interest rate on our home loan. It's one of those things, again, don't let apathy creep into your life. Wealthy people do not let apathy creep in. They're always looking at where they can refine, the payments. Adam discussed about stepped premiums. paying for the level of cover that you need at that specific time, and potentially winding things back as you start to accumulate wealth. These are the little 1%ers that you can do, with a financial planner, with an accountant, with, other professionals that you might have in your team, to make sure that you're absolutely squeezing every single cent and penny in the benefit of yourself. Because remember, all the sayings that I talk about is a dollar saved is a dollar earned. If you can save that dollar, that to me is like earning a dollar, because it's still retaining $1 of wealth, as opposed to you going to have to earn another dollar to spend it, and therefore your net movement of wealth is zero. So it's very important. Don't let apathy creep in. Adam, they're brilliant concepts, brilliant statements you've made about level premiums, which could be slightly higher early on, but it keeps the premium quite level as you age later, and stepped premiums, which is essentially saying, well, I'm going to get what I pay for at that certain time, but at least I know that I'm being as efficient as I possibly can. Now, long term, do you see, if someone's been very good with the way that they've structured their step premiums, do you see them potentially getting maybe a little bit more of a benefit than someone jumping on a level premium early on, or is it much of a muchness?
Well, so our preference generally now is for stepped premiums, because it also gives you the ability to shop around, so to speak. You don't want to shop your insurance around too often, because you have to go through medicals and your medical situation changes as you age. But if you're in a level premium at 30 years old, as an example, and you're now 38, you have to take out a level policy elsewhere as a 38-year-old. So generally, you're stuck with that level 30-year-old policy that you took out, at age 30. So what STEP does, it allows you, because all the insurance providers are offering step premiums at that certain age, you can shop your insurance around, and if there's a considerable saving somewhere else, you go through the underwriting process because your health hasn't changed much and it's approved, you have that ability to port your insurance elsewhere and shop it around. I do premise, though, do not cancel any insurance policy till you have an alternative set up, because you don't want to be left with no insurance, and medical sort of benchmarks do move. But all things being equal, stepped gives you another strategy to manage cost of your insurance.
Beautiful, mate. Now, Adam, just before we round everything up, I just wanted to chat with you, and I know we've been talking about it off air, but this was really important. This was around income protection insurance, because I see this many, many times with my clients, especially the younger ones. They've job top and new super funds are being created, but I've seen them have 3 or 4 industry super funds, and I'm not going to name them, but 3 or 4 industry super funds, and for some reason, they've probably opted themselves in for a standard income protection insurance policy. Let's say an event does happen and they've got 4 super funds with 4 income protection insurance policies. What's the deal? Do they get paid on 4 income protection insurance policies? 1? None? What's the outcome? If you can just kind of walk us through that. An event occurs, eligible for income protection insurance, they've got 4 policies. What's the outcome?
Well, the disappointing news is you can't get 4 salaries paid through 4 different insurance companies. There is an overarching regulation that applies, and that is that you can't generally be better off on claim than you were prior to the claim. So generally, as policy 1 is paying, policies 2, 3, and 4 will not pay, because you are obtaining 70% of your pre-injury salary. So really important that you're not paying for 3 or 4 different policies, because they won't pay. You can't be better off on claim than you were prior to the claim. But I would suggest seek advice, because it's really important that you look at the features of each policy before you decide to cancel one. For example, one might have a wait period where you can claim on it after 30 days. One might have a wait period of 90 days, so you might opt for the 30-day one if you don't have significant savings behind you. One might pay you for a period of 2 years, one might pay you for 5, one might pay you to 65 years old. You might opt for that 65 age policy, because obviously that's when the normal retirement age was originally set at. So have a look under the bonnet, make sure you're not paying unnecessarily, but seek some advice on which features and which policy best suits your circumstance.
So in short, you won't be better off than what you were when you're getting a salary. So sorry guys, if you're making $10,000 a month, they're not going to pay you 28 grand, which would be 70% of each policy essentially. So there's only one that's going to get paid out. But the second part of that you need to explore is make sure that before you just go ahead and cancel 3 or 2 out of your 3 or 4 policies that you may have a look, as Adam said, great analogy, look under the bonnet and actually have a look at the intricacies of the policy and understand the pros and cons and where the benefits are, and make sure that you're retaining the policy that's going to give you the best outcome, again, if an event occurs. Mate, that was brilliant, because I just wanted to touch base on that, because that's something so important that a lot of people just don't recognise, and I see it quite often, especially as an accountant. They're paying for 2 or 3 or 4 policies from 2 or 3 or 4 super funds that they might have, because they've just opted in for potentially a standard pack, or they've clicked yes. Mate, appreciate it.
That's brilliant. Thank you, mate.
I need to say thank you very much for, again, joining us for the second part of this 3-part series. It's been fantastic to see how wealthy people kind of structure things, especially around insurances, because I do feel there's just not enough education on it. So some of the insurances, again, just recapping what Adam's discussed, he's discussed about life insurance and TPD, typically being one of the same policy held with inside super, and that little hack around being able to get it as a tax deduction, that is through salary sacrificing from your wage into superannuation, and that's why you're getting a pre-tax benefit in your personal name. So that's a brilliant little hack that you can save thousands upon thousands of dollars in the long term. Understanding trauma insurance, again, if you do, and touch wood, it doesn't happen to you, but suffer a traumatic experience from a health perspective, you can get that payment being made to you tax-free. And generally, Adam, you would say it happens fairly quickly. Is that right?
Absolutely. The good thing about trauma, it's paid on diagnosis. So it's not whether you're at work, not work. It's I've had a heart attack. You submit that paperwork, it's paid very quickly.
So a substantial level of benefit, especially to get you through those harder period of times. Because if you're sick or suffer a traumatic experience health-wise, you want to make sure that you can take the time that you need to rest and recuperate, because they always say there's no better investment than your health. And that last one being income protection insurance, again, little known, not many people have it, or they may have it as a default policy with Inside Super, or maybe they may have bought it from a website, who knows. But it's important that as you start to progressively increase your liabilities and family and other commitments, you do have a very solid income protection policy. Make sure you understand all the terms and conditions of it, of course. And then as you get older, you may not rely on an income protection policy as much, and it's something you can wind down or cancel altogether. There's so many redundant insurances I see people pay for, especially when they're retired. I've seen clients, Adam, still paying for income protection insurance, and they've been retired for many years. It's just something that they just continue to pay. And again, they allowed apathy to get into their course of their everyday life. Adam, thank you once again for being involved on this second part of our 3-part series. If you want to get in contact with Adam, you can reach out to him at fruitionwealth.com.au, or contact him on the landline number 024623 5566. He's always happy for a chat. Adam, thank you very much, and I'm looking forward to our final episode of our 3-part series. Stay around, because this is probably one of the most juicy ones. This is assets that you should be holding at retirement, or assets the wealthy people at retirement hold. So Adam, thank you once again. Really looking forward to all your knowledge and experience that you have to really discuss us and navigate us through what you should be holding at your retirement.
Thank you, Jeremy. Pleasure to be here, mate.